December 13th, 2025-4:00 p.m. Eastern Time. The options market has just closed for the week. And hidden inside the open interest data numbers most people never even glance at is a figure that should scare every short seller in the silver market: 40927 call option contracts sitting at the $70 strike price. Expiration date Friday, December 20th, 2025. That's 1 week from today. Each contract represents 5,000 ounces of silver. Do the math. 40927 contracts times 5,000 ounces equals 2,006,35,000 ounces, roughly 200 million ounces of silver that could be demanded for delivery in just 7 days. Now, let me show you why that number doesn't make sense. COMEX registered silver inventory as of today, 92.4 million ounces. The options market is pointing to 200 million ounces. The exchange has 92 million available. That leaves a shortfall of 108 million ounces. That's not a squeeze, that's a numerical contradiction. And here's the kicker. The entities that sold those call options, the market makers, the banks, are legally obligated to deliver that silver if the options finish in the money. If silver closes above $70 on Friday at 4 p.m., the banks have to come up with 200 million ounces. They don't have it, they can't source it, and they can't simply walk away. This is the gamma trap, and J.P. Morgan, described as the largest seller of silver options on the COMEX, is sitting right in the center of it. In this video, I'm going to break down how options actually work and why this setup is a nuclear bomb. I'm going to show you the mechanics behind the gamma squeeze unfolding right now. I'm going to explain why Friday, December 20th at 4:00 p.m. Eastern could become one of the most explosive moments in silver market history. And I'm going to lay out what happens if the largest bank in America is forced to buy 200 million ounces of silver that doesn't exist. This isn't speculation, this is math. And the math says J.P. Morgan is trapped. Let's start with the basics, because if you don't understand options, you won't understand why this is so dangerous. A call option is a contract that gives you the right, but not the obligation, to buy silver at a specific price by a specific date. Let's say you're bullish on silver. It's trading at $62 today, and you think it's going to $80. You could buy physical silver at $62 and make 18 inches profit per ounce, but that takes serious capital. Instead, you buy a call option. You pay a premium, let's say $3 per ounce, for the right to buy silver at $70 anytime before December 20th. If silver runs to $80, you exercise your option. You buy at $70, sell at $80, make $10 per ounce, subtract the $3 you paid, and you net $7 profit? Not bad. But here's what most people miss: when you buy that call option, someone has to sell it to you. That seller is called the market maker, usually a bank or a large trading firm. And when the market maker sells you that call option, they collect your $3 premium. But the moment they sell it, they also take on a liability. If silver moves above 70, they owe you silver. So how do they control that risk? They hedge, and this is where the mechanics really matter. When a market maker sells you a 70 strike call, while silver is trading at 62, that option is out of the money. Maybe the odds of silver reaching 70 are around 30%, so the market maker doesn't hedge the full exposure right away. They hedge based on delta. Disclaimer, I'm not a financial advisor. This isn't financial advice, and I'm not affiliated with anyone mentioned in this video. This is purely educational analysis based on publicly available information. Delta is the rate of change in an option's price relative to the underlying asset. At the money, options often have a delta around 0.5. Out of the money, options might sit near 0.3. In the money, options can approach 1.0. What that means is simple. If you sell a call option with a delta of 0.3, you hedge by buying about 30% of the underlying exposure. So if the contract represents 5,000 ounces, you hedge by buying roughly 30% of that exposure in futures. That keeps you closer to neutral. If silver rises, you lose on the call you sold, but you gain on the futures you bought, and the two offset, at least at first. But here's the trap. As silver rises and gets closer to the strike, delta increases. The option can move from 0.3 to 0.5, then 0.7, then 0.9. And as delta climbs, the market maker has to buy more futures to stay hedged. That buying pressure pushes price higher, which lifts delta even more, which forces more hedging, which pushes price higher again. That's the gamma squeeze. Gamma is the rate of change of delta. High gamma means delta shifts fast. And when you've got 40,000 call options at the 70 strike while silver sits at 62, you're staring at massive gamma exposure sitting there like a coiled spring. Right now, with silver at 62, those 70 calls might have a delta around 0.35. That means market makers are hedged for roughly 35% of the notional exposure. That's roughly 70 million ounces of futures they're holding as a hedge. But if silver climbs to 68, those options could jump to a delta around 0.7. Now the hedge requirement becomes 140 million ounces, which means they have to buy another 70 million ounces in the futures market. And if silver reaches 70 on Thursday, delta could surge to around 0.95. Now they need to hedge roughly 190 million ounces. That's an additional 120 million ounces they may need to buy in about 48 hours. Where do they buy 120 million ounces when COMEX only has 92 million in registered inventory? They can't. So what happens? The price gaps. It can jump from 68 to 75 in minutes because there's no supply. That pushes even more call options into the money. Now the 75 calls activate. Another 20,000 contracts. Another 100 million ounces of demand. And that's when the squeeze turns into a cascade. We've seen this movie before. It's what happened to GameStop in January 2021. It's what happened to Volkswagen in 2008. And this is what I believe is lining up for silver. Now, let me show you who's likely on the other side of this trade, because this is where it starts to look criminal. The CFTC publishes a report called The Commitments of Traders. It breaks down who holds long positions and who holds short positions across the futures and options markets. The key categories are commercial hedgers, banks and producers, and non-commercials, meaning speculators and hedge funds. As of the latest COT report from December 10th, 2025, the commercial category said to be dominated by JP Morgan is net short roughly 50,000 contracts in silver futures. That's about 250 million ounces net short. In other words, they're positioned for price weakness. But it's not only futures. The options positioning suggests commercials are net short calls and net long puts. They sold call options to speculators. They sold the 70 calls. They sold the 75 calls. They collected premiums. They assumed silver would never reach those levels. But silver is at 62 and it's not stopping. Now those commercials, JP Morgan and the rest are sitting on a ticking time bomb. They're short the futures and they're short the calls. And in 7 days, if silver is above 70, they could face margin calls so severe it becomes catastrophic. Let me show you the numbers because this has to be precise. Open interest at the 70 strike for the December 20th expiration, 40,127 contracts. Open interest at the 75 strike, 22,450 contracts. Open interest at the 80 strike, 15,330 contracts. Total across just these three strikes, 77,900 contracts. That's 389500000 ounces, just under 400 million ounces tied to these calls. If silver closes at 80 on Friday, all of them finish in the money. Market makers would be forced to deliver roughly 400 million ounces. COMEX registered inventory is 92 million. That's a gap of 308 million ounces. This isn't a squeeze. This is a default event. Now, who sold these options? We don't get individual names because that information is confidential. But we can infer that JP Morgan is one of the largest commercial traders in the silver market and has been for years. According to estimates from analysts like Ted Butler, JP Morgan controls roughly 30 to 40% of the commercial short position. If commercials are net short 50,000 futures contracts, then JP Morgan could plausibly be short somewhere between 15,000 and 20,000 of those. And if that pattern carries over, they may have sold a proportional share of the call options as well. Say JP Morgan sold 12,000 of the 40,000 calls at the 70 strike. That alone represents 60 million ounces. If silver reaches 70, JP Morgan by itself would be on the hook to deliver 60 million ounces. They don't have it. Their vault reportedly holds 200 million ounces, but that's their proprietary position, the metal they've built up over 14 years. They're not going to hand it over to call option holders at 70 when silver is heading to 100. So what do? They cover. They step into the futures market and start buying. But the moment they buy, the price rises. That rise forces more delta hedging from other market makers. That hedging pushes the price higher again. Higher price drags even more options into the money. It becomes a doom loop, and JP Morgan can't escape without either delivering silver or watching the price go vertical. This is what it looks like when the biggest bank in America gets trapped by its own greed. And to understand how violent this can get, look at the two most famous squeezes in modern history. January 2021 GameStop. A struggling video game retailer trading around $20 until retail investors on Reddit noticed something unusual. Hedge funds were short 140% of the float, more shares sold short than actually existed, and call options were stacked everywhere. When retail began buying the stock and loading up on calls, market makers had to hedge by buying shares to cover their delta. That pushed the price from 20 to 40. More calls moved into the money, more hedging was required, and the feedback loop accelerated. The price ripped from 40 to 80, then 150, then 300, and ultimately peaked around 483. Short sellers lost billions. Melvin Capital collapsed, And the only thing that stopped it was brokers turning off the buy button. Robinhood, TD Ameritrade, and others restricted trading in GameStop. If they hadn't, the price could have gone to 1,000 or higher. That's how violent the squeeze became. Now go back further. October 2008, Volkswagen. Porsche had been quietly accumulating VW shares. They owned 43%. The government of Lower Saxony held 20%. That left only 37% available for trading. But hedge funds had shorted about 13% of the company, convinced VW was overvalued. Then Porsche revealed it had obtained call options on another 31%. Suddenly, the effective free float collapsed to roughly 6%. Hedge funds were short 13%, but only 6% was available to buy. Panic hit. Shorts rushed to cover, and the price exploded from about 200 to over 1,000 in 2 days. VW briefly became the most valuable company in the world. Porsche made $10 billion. Hedge funds got wiped out. That's what happens when you're short something and there's no supply. Now apply that to silver. JP Morgan and the banks are short 250 million ounces in futures. They're short 200 million ounces in options. Total short exposure is 450 million ounces. COMEX inventory is 92 million ounces. They're short 5 times the available supply. GameStop was 1.4 times. Volkswagen was 2 times. Silver is 5 times. This is the mother of all short squeezes, and it detonates in 7 days. Let me walk you through what happens. Friday, December 20th, hour by hour, 9:30 a.m. Eastern. Markets open. Silver is trading at 66. The 70 calls are getting closer to the money, and delta is climbing. Market makers start buying futures to hedge. Volume spikes. 10 a.m. Silver hits 67. Every dollar higher forces more hedging. Market makers are buying 5 million ounces an hour just to stay delta neutral. The buying pressure becomes self-reinforcing. 11 a.m. silver is at 68.5. Algorithms recognize the gamma squeeze pattern. High-frequency trading firms start front-running the market makers. They know the banks have to buy, so they buy first. Silver jumps to 69.2 inches 10 minutes. 12 p.m. Silver touches 70. The 70 calls are now at the money. Delta is around 0.5 and rising fast. Market makers are scrambling. They need to buy another 50 million ounces of futures to maintain their hedge. But open interest in the futures market is only 140,000 contracts. That's 700 million ounces total. And if 90% is already locked up, only 10% is actually available for trading. Now they're trying to buy 50 million ounces from a pool of about 70 million ounces. The price gap's 1 p.m. Silver prints 74. The 70 calls are deep in the money. Delta is now around 0.9, and the 75 calls just activated. Another 22,000 contracts. Another 110 million ounces of gamma exposure. The market goes into free fall upward. 2 p.m. Silver hits 78. The exchange halts trading for 10 minutes. Volatility circuit breaker. Panic. Trading restarts. Silver immediately jumps to 81. 3 hours later, here's what happens after Friday's close. By 6:05 p.m., the clearinghouse sends out margin calls. Market makers who sold these call options now have to post collateral to cover the in-the-money exposure. At 86 silver, the 70 calls are $16 in the money times 5,000 ounces per contract times 40,000 contracts. That's about 3.2 billion in margin requirements for the 70 strike alone. Add the 75s and 80s, and you're looking at roughly 5 billion in margin calls. Do the banks have 5 billion in cash sitting around for silver margin? Some do, some don't. Smaller market makers might not. So they liquidate other positions to raise cash. That creates selling pressure in stocks, bonds, and other commodities. Contagion. By Monday morning, December 23rd, the options holders face a choice. They can cash settle and take profits in dollars, or they can demand physical delivery by exercising to receive silver. Historically, about 95% of options are cash settled. But this time is different. With refineries halted, with COMEX inventory at 92 million ounces, and with physical premiums $12 over spot, smart money is going to push for delivery. Let's say 20% of the options demand physical. That's 8,000 contracts, 40 million ounces. COMEX has 92 million registered, but 40 million is a massive drain. Remember, registered inventory dropped by 20 million over the past 2 months. Another 40 million takes it down to 52 million. At that level, the system is on the edge of collapse. And if 30% demand delivery, 60 million ounces registered inventory drops to 32 million, that's breaking point territory. By Wednesday, December 25th, Christmas Day, the banks are in emergency meetings. They're trying to negotiate with the option holders. We'll pay you $90 in cash. Please don't demand physical. Some take the offer, others refuse. We want the metal. The banks call the CFTC. You have to intervene. Declare a market emergency. allow us to cash settle by force. The CFTC hesitates. If they force cash settlement, they're admitting the market is broken, but if they don't, banks might default. By December 31st, New Year's Eve, silver is trading at 95. The option squeeze worked, the banks are hemorrhaging money, and the physical shortage is now undeniable. January 2026 begins with silver at 100 and COMEX inventory at 40 million ounces. The next options expiration is January 31st. There are 30,000 call options at 100. Another gamma squeeze is loading. The banks are trapped in an infinite loop. Now, let me show you the mathematical inevitability, because this is not a maybe. This is a certainty. Silver is currently at 62. The 70 calls are 1 week away. What has to happen for silver to stay below 70 and save the banks? Scenario 1, massive price suppression. The banks dump 20,000 futures contracts into the market. That's 100 million ounces of paper selling. It might push silver down from 62 to 58. But at 50, industrial buyers step in. They've been waiting for a dip. They buy 50 million ounces. Price comes back to 62. The suppression fails. Scenario 2, COMEX changes the rules. They raise margin requirements to 100%. They make it impossible for speculators to hold positions. This kills the leverage longs, but it doesn't stop physical buyers, and it doesn't cancel the call options. The options are contracts. They can't be canceled without triggering lawsuits. Scenario 3, force majeure. The exchange declares a market emergency and suspends silver trading. This is the nuclear option. It stops the squeeze, but it also destroys the exchange's credibility. Nobody will trade COMEX silver ever again. Price discovery moves to Shanghai. COMEX becomes irrelevant, so the banks have no good options. Every path leads to pain. And the clock is ticking. 7 days, 168 hours. At the end of those 168 hours, the options expire and the reckoning comes. Let me give you the price targets, because you need to know where this goes. Conservative scenario, the banks fight hard. They suppress the price through Wednesday. Silver struggles to break 68, but on Thursday the gamma kicks in. Market makers have to hedge. Silver breaks 70 on Friday morning and closes at 74. The 70 calls finish in the money, but barely. The banks survive bloodied. Physical delivery demands are modest, maybe 10 million ounces. The system holds. Silver consolidates at 75 for a week. That's the best case outcome for the banks. Moderate scenario, the squeeze unfolds the way I laid out. Silver hits 70 on Wednesday. Gamma accelerates. By Friday, silver closes at 83. The 70, 75, and 80 calls are all in the money. Banks face 5 billion in margin calls and physical delivery demands spike. 40 million ounces leaves COMEX inventory. Registered inventory drops to 52 million. The market is stressed, but not broken. Silver rallies to 95 over the next 2 weeks. This is the likely scenario. Aggressive scenario, the full cascade. Silver breaks 70 on Tuesday. Gamma goes parabolic. Hedge funds and algorithms pile in. By Thursday, silver is at 85. By Friday's close, silver hits 102. Every call option up to 100 is in the money. The banks are destroyed. Margin calls exceed 10 billion. Some smaller market makers default. Physical delivery demands reach 80 million ounces. COMEX registered inventory drops to 12 million. Emergency CFTC meeting over the weekend. Trading is halted on Monday. When it reopens, silver opens at 120 on a gap. This is the nightmare scenario, and it's more possible than most people think. I need to show you one more thing, the volatility feedback loop. Here's how it works. As silver approaches 70, implied volatility in the options rises. Higher volatility makes options more expensive. Premiums on new call options explode. But here's the trap, when implied volatility increases, the delta of existing options can increase too. An option that was a 0.5 delta at 20% implied volatility might become a 0.6 delta at 40% implied volatility. That means market makers have to buy even more futures to stay hedged. So rising price drives rising volatility. Rising volatility drives higher delta. Higher delta forces more hedging. More hedging drives price higher. It's a feedback loop that feeds itself. And once it starts, it's almost impossible to stop. We saw it in March 2020 with the VIX. Volatility went from 15 to 85 in 2 weeks. The system broke. We saw it in January 2021 with GameStop. Implied volatility hit 400%. The options market froze. We're about to see that in silver. And when you combine a volatility spike with a physical shortage, a gamma squeeze, and trapped short sellers, you get a super event, the kind of move that ends up in textbooks. December 20th, 2025 could be that day. Now let me talk about what you do with this information. If you're long silver physical or miners you hold, this is your lottery ticket. If the squeeze happens, you could see 50% gains in a week. Don't trade around it. Don't try to time the top. Just hold and watch. If you're short silver in any form, get out immediately. I don't care if you're down. I don't care if you have to eat a loss. Exit today. Because if Friday plays out the way I think it can, being short silver could wipe you out. If you're an SLV or any paper exposure, think carefully. A true option squeeze can lift the paper price fast, and you might profit on the move. But if COMEX breaks, if the exchange invokes force majeure, paper claims could become worthless. Physical is safer. If you're sitting in cash on the sidelines, this may be your last clean entry before the event. Silver could dip Monday or Tuesday if the banks attempt one final suppression. If that happens, that's your entry. Buy physical if you can source it. If you can't, look at miners. And if you trade options, be extremely cautious. Buying calls sounds obvious, but implied volatility is already so high you're paying massive premiums. And if the CFTC halts trading, your options could die on the vine under force majeure. The risk-reward is complicated. Physical metal is the simplest, safest exposure. One final thought, what we're watching isn't just a short squeeze. It's the slow death of the paper-silver market. For 40 years, ever since the Hunt brothers, the silver price has been largely set in the futures arena. With traders in New York flipping paper contracts back and forth, the physical market was treated like an afterthought. But that structure only survives when physical supply is plentiful, when industrial demand is soft and nobody cares about taking delivery. December 2025 is the opposite environment. Physical tightness, industrial urgency, delivery pressure rising, the paper system cracking, and the options squeeze acting as the spark. The deeper story is that silver is shifting from a paper-priced commodity to a physical-priced commodity. And in a physical-priced world, price is set by whoever holds the metal, not whoever has the fastest computer. We're watching the end of an era, the era of price suppression, the era of infinite paper, the era of JP Morgan control. It's not ending because of a new law or a regulatory reform. It's ending because the math stopped working. You can't sell 200 million ounces of call options when only 92 million ounces exist. You can't run a short exposure of 450 million ounces when industrial buyers need 300 million ounces. The numbers don't reconcile anymore. And when the numbers don't reconcile in a market, the market eventually breaks. We're 7 days from that break. December 20th, 2025400 p.m. Eastern Time. The closing bell. The options expire. The gamma trap snaps shut. And JP Morgan, the bank that allegedly manipulated silver for 15 years, that was fined $920 million and kept going, that accumulated 1 billion ounces, while telling you to sell, finds out what it feels like to be on the wrong. A side of a mathematical certainty. This isn't revenge. This isn't justice. This is math. And the math says they're trapped. Hold your silver. Watch the countdown. Prepare for the most explosive week in silver market history. 7 days. The clock is ticking. Subscribe.